Passive income. I'm making almost 24% return on my investment. My total profit so far has been just over $2,000. My annual dividends are $3,615. So I've almost replaced 1 month worth of income. Getting closer. So 14% of my portfolio is BITO, 11% is KLIP. Oh wait, no, I read that wrong. Anyways, no, those shares are up those percentages today, or those stocks are up those percentages today. So anyway, yeah, I got $2,000 in BITO, which is good and bad. It's kind of down for the last 5 years, but it's still pretty much stable. My brother dumped $15,000 into BITO, and now he's making almost $1,000 a week. So, I mean a month. And they're paying like 68% return on your investment. So as long as they don't go under and they keep paying a good return, you know, they're doing good. You're doing good. Orange dot is where I sold some of my stock, but the rest of it I've been buying. Buy. I can't remember why I sold on that day. Oh, there's two of them. Not sure why I did that, but anyway. I probably needed the money. Yeah, because I sold some KLIP stock about the same time. Okay, I'm back. I had a phone call. So anyhow, Zem is probably one of my favorites. Their dividend is 54%. I should have kept my money in there and never took it out, but I needed the money. So long story short, they didn't pay a dividend for like a year, a little over a year, and then when they did pay a dividend, they cut it down to like 1%. That being said, the cash value went up, and I was able to make the money off the cash value side that I was supposed to make off the dividend, so I just cashed it out. But anyway, yeah, I should have left it in there, but it's okay. I've been investing in other things like BITO and stuff, and now I'm reinvesting in Zem now that the dividends are back up again. Because what I was trying to do is only invest in dividend stocks that pay more than the interest rate on my debt. So since Zem dropped to 1%, I cashed out the money that I should have made off the dividends, and then I left the rest in there. I just left it, I didn't cash it out. It's like, I leave it in there and see what happens. And as the dividend yield started going back up again, I started putting more money back in again. So I mean, I didn't do bad. I didn't do bad, so I'm all right. Anyway, so now I've got about $1,000 in there again. I think I had $2,000 in there at one time. The cash value went up to $3,000. Yeah, I got $1,000 in there. I had $2,000 at one time. The cash value bumped it up to $3,000. Actually, I got a little less than $1,000 in there because it's up by $300. Does it say what I got in? No. Oh, here we go. Okay, so I have just under $1,000 worth of shares. And I've made $550 in dividends. And the stock is up. Not by much, but it's up. ARR, that's my next biggest one. They're paying 18%. I don't know what the dividend ratings mean, but I'll have to look into that. But they consecutively pay like 24 cents a share last year, 40 cents a share the year before, and 24 cents a share this year. Oh, per month. So the dividend yield will go up as the stock goes down, and the dividend yield will go down as the stock goes up. And so that's how I base how much money I'm going to put into it. So if it's 14%, I throw in $14. If it's 15%, I throw in $15. That being said, if the stock is up overall over the last 5 years, then I'll throw a 0 on that. If it's down over the last 5 years, then I won't. Because if it's up over the last 5 years, it shows stability. If it's down, then, well, it depends on how much it's down. It might only be down $1. But if it's down, then I don't invest more. I just put in, like I said, if it's 14%, I throw in $14. But if it's up over the last 5 years, on average, then instead of $14, I'll throw in $140. So that's how I do that. I used to do it differently, but that's how I do it now. That way, I'm putting more money in if it appears to be a long-term stable stock. So like this one, the stock is down over the last 5 years. So, and it pays 18%, because I round down. If it's 18.5, I'll round up. But it's 18.44, so I round down. So when it pays me my dividend, which is monthly, I just throw in $18 a month. If the stock was up, then I'd be throwing in $180 a month. If it was up on average over the last 5 years. But anyway. Before, I was just being like, if it's an ETF, I'll throw a 0 on it if I got the money. But even ETFs are not always stable, so they're more stable maybe than a regular stock, but that's not 100%. So that's why I changed my formula. If they got a good 5-year streak, then I'll invest more. After that is EETH. BITO and EETH are both crypto ETFs. Or at least I believe EETH is a crypto ETF. I know BITO is. That being said, crypto. There's a new feature, I don't know how new, but I just noticed it. I just found it not too long ago, where you can stack your crypto and earn interest on it. So I'm not big on crypto, but that part of it is intriguing to me, because then you can, it's like a dividend. You earn interest on your crypto. This is confusing because I'm pretty sure I made more than $8 on BITO the other day. I think it was $8 per share. Now this is the Snowball app. It's really cool. It's totally worth paying for, and I actually did pay for it. I'm sure there's an affiliate link, but I don't know. Let me see if I can find that real quick. Okay. I guess there is... Oh, wait. Oh, there it is. Okay. So my affiliate link ID is 6463484375. If you want to give me credit for it. If I remember, I'll put it in the comment section or the description section below. But anyways, alright. I'm not doing this to make money, but I mean, I'm doing the dividends to make money, but you can check out the Snowball app yourself. If you like it, then you can pay for it. If you don't. It doesn't bother me any. I don't even know how much money I would make from referring anybody to Snowball. I like them. So, anyways. Alrighty then. Let's go over here. Analysis. I screenshot this quite a bit and do shorts with it, but this is basically my analysis from my portfolio. I received $1,500 this year, I think, or maybe overall. I'm not 100% sure on that, on dividends. My dividends for this year will be $3,600. Or maybe not this year, but that's what I have my annual dividends up to. So from this time from today to this time next year, if I don't put any more money in, this is what I should make approximately, because stocks are always going up and down. There's dividend hikes, dividend cuts all the time. And some of my stocks are high dividend yielding stocks, and so the high yielding stocks are subject to being cut, where the low yielding dividend stocks are subject to growth. So I have a little bit of everything. My brother has more high risk dividend stocks. I have all of the above, high, medium, and low. Trying to keep, well, right now I'm trying to keep my portfolio over 20%. But I got one credit card paid down. I'm working on getting the other one paid down. Once I get those two done, then I'll be working on paying off my pickup truck. And then at that point, I'll be investing in anything that pays more than 14%. So I'll try to keep my portfolio over 14%. And I do invest in some stuff that pays less than, but not much. Not much. And because I'm trying to focus on investing in stuff that's got a higher dividend yield than the interest rate on my debt. So right now my debt is about 20, I forgot the exact numbers, somewhere, it's like 23% to be more exact. So I'm just like, I'm looking at 20%. Anything that pays more than 20%, I'm investing in that. So, and Zem is one of my favorites. It pays pretty good, but it fluctuates. So it might pay 50% today, and it might pay 20% tomorrow. So, you know, but overall, they've always paid a pretty good dividend yield. And just that one time, since I've been investing in them, that one time, they didn't pay for a whole year, and then they cut their dividend to 1%. And that kind of sucked. But after that, it went back up. So, I mean, I lost I could have lost $1,000, but the cash value went up, so I made the money on the cash value side. So for me, it was a win. For other people, maybe not so much. But had I kept that $2,000 in there, it probably would have balanced out overall, because I would have made the money up later when the yield started coming back up. So if I didn't need the money, I wouldn't have taken it out. But yeah, anyways, so internal rate of return is negative 5.74. Now, I'm not 100% sure what that means, but I understand that it's not necessarily good. You want that number to be in the positive. So, as I get more low yielding dividend stocks, I'm sure that number will get better. But negative 5-6% is not that bad. I've seen it as bad as like 11%. So bottom line is I'm making money, and that's, I guess, most important. I'm not losing money. So over the past year, see how much the stock market fluctuates. This month, my stocks are down. Last month, they were up. Last 3 months, they were up. Last 3 months before that, they were down. Then it was up. Then it was down. Then it was up. Then it was down. Then it was up. So yeah, it can be an emotional roller coaster if you're day trading. I don't so much day trade. So I am now got 90% or 95% of my stocks, my dividend stocks at Robinhood and Webull. I'm moving my dividend stocks out of Cash App, and I'm starting to use Cash App more for day trading. I don't really know much about day trading except for the basics, buy low, sell high. I know there's certain algorithms that you look for and this and that and whatever, but Cash App is where I started, so I have a lot of stocks there, and a lot of them are down. I cashed out all the ones that went back up, but instead of just waiting until they go up and then cashing them out, when they're like over $1 or whatever, I decided that I just start using it for like day trading. Now the stocks that are way down, I'm not going to touch them unless they pay a dividend. I'll still reinvest some dividend money, maybe, depending on how badly the stock looks. But and then I'll kind of learn how to day trade a little bit more with Cash App. My brother does more day trading than I do, but I don't really like the risky investing, so that's why I just stick to dividend stocks. So here you can see, okay, BITO is 13% of my portfolio, KLIP is 8%, ZIM is 6%, although ZIM's going to grow. ARR is 5%, and so on and so forth. So, yeah. Sectors. I saw something in here about crypto. Here it is. Crypto. I got about 3% of my money in crypto. Because, like this financial and funds, that's basically like BITO and KLIP. Those are like ETFs and stuff like that. So the actual crypto that I have is about $400 worth of crypto. Not a lot. There it is, cryptocurrency. So I've got 9,000 approximately in regular stocks, about 5,000 in funds, and I think ETFs are considered funds. I'm not 100% sure. Other 500, crypto 400, and cash. I got about $300 in cash, and I don't know what this other is. I have $1.63 in other, whatever that is. I have to think about that one. Countries. Oh, currency. Sorry. Currencies. USDA or USD. Regions. Most of my stuff's invested in North America. 50, almost 53%. Other, wherever that is, 19%. That'd be $3,000. Asia, emerging, $1,500, about 10%. Africa or the Middle East, $1,000. Yeah. Countries. Other. Israel, $1,000. That's basically ZIM. There might be some others, but I doubt it. But yeah, I'm not putting all my eggs in the American basket, but it looks like 50% of my eggs are in America's baskets. So, and wherever other is, I guess other is like other planets, maybe? I don't know. Mars. That's where other is. So, 30% of my investment, almost 31, is invested in other planets. Or moons, who knows, I don't know. Wherever, other countries. Now, there's a whole bunch of countries. I guess these are like the top countries in the world. And so the other is the bottom countries of the world, I guess. I don't know. Crypto might be considered not really even a country because it's like digital currency. It's like out there. I don't know. I don't know what other means. Oh. Okay. Well, this kind of breaks it down a little bit. Okay, XRP is crypto. So some of it is crypto. See, KLIP is Chinese. So why is that other? It should be under China. Oh, but China's not on here. Hong Kong is, but not China. So maybe that's why it's under other. That's weird. Because Hong Kong, I thought Hong Kong was a state or a province, or a city, not a country. But I guess Hong Kong is a country. I don't know. So there you go. that's my dividend stock update. For August the 9th. So I don't know how I'm doing better than the S&P 500. But anyways, that doesn't bother me as much as having my dividends up. So if my portfolio is basically falling just below the S&P, like right here in the past year, about $1,000 behind the S&P, but I'm making $3,000, almost $4,000 a year. That's better than the cash value side, so I'm more than happy. So there you go. Ideally, I would like my S&P, my portfolio, to be as parallel to the S&P as possible, as well as making money off dividends. But as long as it's close, because like the stocks on average, if you're just day trading and you have your money in like the S&P, the stock market grows about 10% a year, give or take. So if my portfolio is only growing on the cash value side at 9%, 8%, just behind the S&P, but yet I'm making 20% per year on dividends. Hey, I'm doing a lot better on dividends, and the taxes on dividends are much lower than the taxes on the cash value side. So if I cashed all that out on the cash value side, I'd be paying regular income tax. On the dividend side, I pay investor tax, which the investor tax is like almost half of what the income tax is. So right there, boom, I'm making money just by saving money on my taxes. So there you go. Alright, I guess I'll leave you at that. Hope this finds you well, and good luck.